Welcome to Everything Money. In this video, we will talk about Roku, the streaming TV service. We will show you the financials and fundamentals behind this company using our Everything Money software. We will transfer this money and show you what you should be paying for this using our stock analyzer tool. And if you're interested in trading Roku, this incredibly disruptive company, Mo will tell you all about it in the trading charts. Mo, you love this company and we'll tell you more. But first, why should you be listening to us and not Kathy Wood? Well, the point is I bring your normal person questions about a company like Roku to a couple wealthy guys that manage and maintain over $100 million in real estate all over the world, stocks, and multiple businesses. This is not BS, folks. We will look at Roku today, and I'll show you right now this guy named Paul. It's Paul, right?
It is.
Go on.
Thank you, Uncle Seth. So first off, follow us on Instagram. We have a new Everything Money account, and then follow us personally. That way we don't feel left out. So guys, Roku, let's just talk about the product first.
I don't know much about it.
I
don't know much about it.
I prefer Apple TV.
Me too.
That is my preference. But now...
So you guys know I'm the ultimate Apple fanboy, and I prefer Roku.
How dare you?
But didn't you say, like, is Apple incorporating Roku or vice versa?
Roku has Apple TV on it. So now I have I use my phone as the remote.
What's the point of having Roku then?
Well, it's like $20, and I can buy 6 of them for... I mean, if I was going to go buy 6 Apple TVs, that's $600 plus tax. With this, I've spent $120.
Plus
and
tax.
It's exactly the same thing.
Plus tax.
Mo, I'm going to blow your mind because I bought like a $100 TV from Walmart. It has Apple TV built in the TV.
Apple TV's built into it.
I don't need the box anymore. I was shocked too. But let's get after these financials.
All right, so guys, we're going to use our Everything Money software, which you'll hear more about as the time goes on in this video. Click the 8 Pillars tab. Type in Roku. I think I know how to spell it. There it is.
We use our 8 pillars to quickly screen a company. We'll show you how fast we can get this done so you can look at it quickly and know, should I be investing in this? Like, what kind of money do they make and are they diluting me? Go ahead, Paul.
So guys, first off, it's a $40 billion company. The first pillar is 5-year PE under 22.5. This one says NA. Why does it say NA, Seth? That's exactly right. They have not made money overall in the last 5 years. Last year's PE is 172. Okay, so first, when I see these big numbers, my first thing I want you to do is go look up other $40 billion companies. Go look up companies between $30 and $50 billion and see what kind of revenue and profit they make. That way you can sit there as a comparison and say, is Roku really worth it for me? Pillar number 2, we want the 5-year return on invested capital to be greater than 9%. We make our invested capital based on free cash flow. We do have a free cash flow over the last 5 years, but the 5-year return on invested capital is 1.1%. That is an X. Now, keep in mind, guys, they probably haven't had much free cash flow in the last 5 years because they're growing and growing and growing, and that's why the number is so low. But we want over 9%. It's 1.1. So far, we have 2 X's. Not a great start. But remember, this is a fast-growing company, hopefully, so we have to go figure that out.
In comparison, Biogen's a $40 billion company.
Biogen is?
Hilton, Old Dominion Freight Line, trains. So this company's been around a long ass time.
And you're going to sit there and say, yeah, but they don't have the potential of Roku. Understood. And potential, you should pay more money for companies with more potential for growth, but you can overpay for growth. And that's what everybody usually does. So I exhibit caution, especially in markets like this. So pillar number 3 is revenue growth of the last 5 years. We got it, folks. 436 to 2.3 billion. I'm actually surprised by this because I thought Apple TV was just overtaking Roku like crazy. So that's a check mark, phenomenal.
Mo, does Roku make their own programs like Apple TV?
Do they have their own studio, you mean?
Is that what?
No, they don't.
Oh.
They don't have, they just make devices. And they come on like televisions, like you just said.
So I think the big thing for me is Apple's ingrained in all of our lives. Like, I don't know.
I like it.
Okay.
And you know what the thing is like, yes, Apple's ingrained in all of our lives, and you would think that disrupting the Apple ecosystem would be a bad thing. I've never experienced that issue. That's why I don't use...
But you don't get to watch Ted Lasso on Apple TV, do you?
On my Roku, I do.
Do what?
Remember Roku has Apple TV on it,
Lord
so I just
help me. This is confusing. Go ahead, Paul.
So guys, pillar number 4
profit
is
growth,
profit growth the last 5 years. Negative 34 million, and they finally made a profit, $227 million.
Paul, actually, someone might be wondering, why don't we know anything about this company? Yeah, please tell them.
So one of the most common criticisms that we get from really stupid people is you should understand the company first before you look at the numbers. Exactly the opposite. You should not look at the company. Here's why. if you understand the numbers first, you can immediately say this is massively over. Like, for example, if I was just doing this without a video, I would have already moved on.
Yeah.
I would not even wasted my time. But if I sat there and listened to Mo going, man, Roku is awesome. I did all this research on the company and then looked at the numbers going, yeah, but it's overpriced. I just wasted a bunch of my time doing research. If you do it the other way, you're just trying to convince yourself of why you should buy a company as opposed to looking at the numbers and saying, hey, does that mean you're gonna miss companies? Absolutely. But your time is valuable. If you do the research on the company first, understand the company first, you don't value your time. You hate your time. You hate your money. You hate yourself and you should because you're stupid.
Oh, yes, thank you, Paul. Appreciate that.
Next one.
That's where I wanted to go with that.
Pillar
number five. His shares outstanding.
By the way, you know what's funny? I was talking about my cousin. Never do I ever get a text from my cousin going, man, you're such a jerk. Probably because he knows I'm a jerk. He's just like,
is this your idiot
Paul.
cousin?
What was that?
No,
this is the cousin I like. If it was my idiot cousin in California, also named Paul, I would just be ignoring the email. I would just, the text. I'd probably already blocked him. And I hope my cousin in Canada is probably like, dude, you're such a dick. This is our cousin. Like, yeah, I don't like him. So,
pillar number 5.
Pillar number 5 is shares outstanding. Guys, I haven't even looked at this yet, but I'm very confident this company's been issuing tons of shares and diluting its owners.
I would think so.
This is a silent killer in stocks. The diluting of stocks, diluting of the ownership. If you own a share out of 10, you own 10% of the business. If they increase that to 12 shares, you now own 8.33% of the business, and they're diluting you. Shares outstanding, 94.75.
Drum roll, please.
132.
Uh-oh.
So 50% increase in shares outstanding. So what this means is if the company is 50% more valuable in terms of revenue and profit, you basically broke even. You saw no growth in there because they diluted you 50% as well. Okay.
No bueno. Pillar number 6 involves their debt. Paul, show us.
So what we do here is companies with less debt are more likely to survive, especially recessions. So what I do is I go back to our main page on our Everything Money software, exclusive software. I go to that nice little line right there, 5-year average free cash flow. I multiply that number by 5. That's $130 million. So what I want to see is I want to see their total long-term liabilities under that $130 million. So I scroll back up to the top. And by the way, I will show you guys soon on the software that you don't have to do all this work. We do it for you. But we're trying to teach our process. Go to the balance sheet, scroll to the bottom, $466 million. This does not scare me. Even though it's an X, their free cash flow is very, very low because they've been growing and spending a lot of money on growth. So their free cash flow is likely to be very low.
Tell us about that free cash. Obviously, we want it growing, and it'll transfer into what market cap we want to pay if we buy the whole company.
Free cash flow is cash from operations, less your capital expenditures. You can do 5 things with that. Buy back shares, pay down debt, make acquisitions, pay dividends, and reinvest in your business, which they've probably been doing a lot of. We go here. I've added this free cash flow line to our software right here in the line. $8 million to 180. Check mark there with an average of 26. So our last step is we take that $26 million average, multiply it by 20 to come up with a market cap that we want to look at for this company, $520 million.
Oh, God. The market cap's $40 billion.
Again, guys, this is a low free cash flow business right now, so it's an X. And like I said to you guys, let me show you guys our 8 pillars tab. Makes everything easy for you. We do all the math for you. Very simple. The reason we did this was because all of our subscribers early on in our company said, hey, instead of me waiting for you to make videos, I want to do my own research. How do I get access to the software? So we made the software for everybody. We did this. You get everything that we've seen here. You get a stock analyzer tool, which will show you next. That'll tell you exactly what to pay for the company. You get it all on a mobile app. All on a mobile app. You get exclusive daily content, 2 or 3 videos a day that we send to all of our subscribers. You get access to Seth, Mo, and I. And you get the community of 6,000 people who already buy the software. If you're alone on an island, you feel like you can't talk to anybody about investing, this gives you access to everybody there who already thinks very similar to you to talk. And this is all available for only 90 cents per day. This is a no-brainer. 90 cents a day if you're able to use the software to increase your returns by 1 or 2% or decrease your losses. This is a no-brainer. 90 cents a day could lead to hundreds of thousands, if not millions. And you get all of these extras that come out as time goes on at no extra charge. 90 cents a day, no-brainer. Let's go to the stock analyzer tool.
Paul, you talk about being on an island and by yourself. I just realized that we're loved all over the world. I got messages from Trinidad. People are on an island, actually, Paul. A real island.
So what's somebody from Trinidad and Tobago called? Trinidad Tobagan?
I would have to.
I really don't know.
Trinidadian?
Trinidadian?
Trinidad.
All right. So here's a stock analyzer tool. This has been one of the most popular options on our site because it literally tells you what to pay for a company. Now, it's going to be hard with Roku because they've just recently started getting profitable. So I'm going to make some major assumptions on the profitability. I'm going to pick my first option as number of years of analysis. I'm going to go 10 years of analysis, and I'm going to make low, middle, and high. 3 assumptions. Revenue growth. They've grown a lot lately. 15, 25, 35%. I think 35 is high.
That's high.
Okay.
Not for Trinidadians, though. Keep
Share
going.
change. 10, 5,
Oh, come on.
10, 6, and 2.
That's...
Profit margin. Let's go with 10, 12, 13, and 16. Same with free cash flow, even though they've never made this, guys. PE. Guys, I hate to say it, but 15, 20, and 25. Price to free cash flow.
You're going to get crushed for that one.
Yeah, this is going to be bad. Now return, guys.
PE should be 100.
I always do 12.5%. And by the way, for those of you out there going to say, no, this PE should be higher, you're basing that purely off seeing this. Guys, at the end of the day, the bigger and bigger a company get, the lower and lower the PE should be because the growth potential is not there. If you want to argue with me about it, go ahead. There's another moron on YouTube who says Tesla should be a 70 PE when it's the largest company in the world by 5 times. Doesn't make any sense. So we hit the analyze button at $302 a share. Oh, the very highest of high assumptions makes it work. 35% revenue growth in the next 10 years, guys, would take this company to revenue of $44 billion. If that seems reasonable to you, it's going to do okay.
I'd really like to ask a question. I'm being dead serious right now when I'm asking. I know there's people watching this video that are in love with Roku and you're a bunch of hype dorks and everything. I'm being dead serious right now. What is disruptive about this company? I truly, truly, truly want
Literally
to know.
nothing is disruptive.
Literally not. I'm just, like my mind is blown when I hear that this gets thrown into the disruptive category. I'm like, why? You're
and you
streaming
love it.
Something. It's not, I don't get it. Like, I really want to know. Please comment at me, at Trader Mo. This is why this company is disruptive, you idiot.
And different from the other, how many streaming services?
And different from Chromecast and Apple TV and Amazon Fire. Like, what makes this company disruptive?
Personal
Is it just
bias.
because they're by themselves and Roku and this is all they do? Is that what's disruptive?
It's not disruptive.
Thank you.
That's it. It's not disruptive.
Idiots. Please tell me.
If you're looking to trade Roku at a quicker pace, you can join Mo and get chastised all day long in the Bidnass Nation. He will show you these trending charts right meow. Show us, Mo.
So the good news is we're sitting right here at, I'm just going to start drawing these lines. We're sitting at a very nice support level, just under all the major moving averages. So how would I approach this? I would look at this thing and say, okay, if we can get an influx of volume coming in here, unfortunately earnings didn't help. Maybe we can start to make a little bit of a charge up and get to the 200-day moving average and maybe sell around $366. What I would rather do is jump over here to a 15-minute chart.
Give it to me now.
And see what we can do as far as trading this thing. So Roku, I'm assuming it has pretty high beta, where that means you could, maybe not. Okay, I take it back. Don't 15-minute trade. I would just come over here on a swing trading chart, look for really good volume. You're going to get that often because a lot of people pay attention to this thing. And wait for engulfing candlesticks. Wait for an uptrend. This is probably going to be a stock where you can go up and down because it does have that daily volatility. So if you want to learn how to trade that way and you want to learn how to consistently make money on a company like this going up and down, come join me in the Bid and Ask Nation. You'll get all my teaching videos of how to do that.
Final take on Roku, Paul. This incredible company. It's the best thing ever made.
Not touching it.
Okay. At some point, maybe.
I mean, yeah, years down the road, if they figure out a way to, yeah, maybe the valuation comes down, but I think there's other options that are better at $40 billion.
That's our take. Fondle thumbs up. Join the software below. Get the software now, and we will see you on another live stream. See you guys.